So the question on a lot of people's mind right now is, when will a house in Canada be affordable again? And that's a tough question to answer, but I'm going to do my best in today's video. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. Thank you to the 14,300 subscribers who have already subscribed. You're already entered into the draw. For those of you who aren't, when we get to 25,000 subscribers, we're going to give away $5,000 for somebody to put into one of their registered savings accounts, into their TFSA, to pay down debt, or simply to apply to their mortgage. But you have to be subscribed to win, so go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss when a house in Canada is going to be affordable again, because a lot of people are sitting on the sidelines going, hey, I'm gonna wait right now and I'm gonna hope that housing prices come down and I'm gonna get a really smoking deal when this all comes crashing down. Well, the question is whether or not it's actually going to come crashing down. And the answer is, it's anybody's guess. Even the best economists in the world aren't going to be able to tell you whether it's absolutely going to crash or whether it's absolutely not. And yes, there are people out there, there are hedge fund managers out there who are betting against the Canadian real estate market. There are also those out there who are betting heavily for the Canadian real estate market. And the reality of it is this: for most people, if you are out of the market, you're going to miss out on potential future gains. And if you're in the market, yes, you are going to take a risk of losing a little bit of money. But if you're looking at this from a short-term perspective of, is the market going to go up a bunch in the next year or down in the next year, you're probably looking at it from the wrong perspective, because buying a home is all about long-term thinking, not short-term thinking. And people who are trying to time the market right now are doing what's called short-term thinking. They're trying to make a long-term buying decision based on short-term thoughts and short-term analysis. So that doesn't really help the whole situation. But that being said, I am going to talk about where the market is now and where it may be going in the future, so that you can better make this decision if you want to take short-term data and look at that and factor it into your buying decision. So let's hop in here real quick. I just want to show you a couple of the news articles. First and foremost, there seems to be some relief in sight. Lumber prices, according to Better Dwelling, have crashed over 45%, and they're dropping on average at a point per day. Now, I went and verified the data on this a couple of weeks ago, and yes, it is true. Lumber prices are coming down. So why is this? If there's all this inflation and prices for everything are going up, why all of a sudden is lumber prices, which has kind of been like the single biggest driver of inflation, why all of a sudden are those prices coming down? And the answer to that is really simple. It's because the increase in lumber prices had less to do with the fact that money was being injected into the economy and more to do with the fact that there was just supply issues. And the supply issues stemmed from lockdowns and there not being as many shifts to produce the lumber and all the things that came along with the pandemic. So the good news is, with lumber prices coming down, that means that there should be more supply of lumber and therefore lower prices, and therefore lower prices on houses that are getting built. So that should create a little bit of certainty in the market going forward that housing prices aren't going to continue to skyrocket through the roof. Now, the other thing that we've seen in the last couple of weeks is we have seen that the market is seemingly cooling. Now, don't get me wrong, home sales are still at record levels, but they're coming off those March and April highs. May was a significantly lower month with respect to sales across Canada, and I suspect that June will be slightly lower as well. And that confirms that we're at least going to get a little bit of relief from skyrocketing prices. But then the question remains, when are housing prices going to start to go down? And there's a lot of people out there predicting that with high inflation, now keep in mind, lumber's falling by 45% in value right now, but with high inflation comes higher interest rates, and that will eventually tank the real estate market and provide for better buying opportunities. Well, be careful with that assertion, because what I'm going to do is I'm going to hop over here into the most recent article from BNN Bloomberg. And when I say most recent, I mean from 31 minutes ago. And this is Benjamin Tell advising Canadians and the Bank of Canada that rapid rate hikes would be devastating for housing and, quite frankly, for the overall economy. So the gist of what Tal is saying in this article, and by the way, I believe that Benjamin Tal is one of the best economists in the country. I sometimes think that he goes a little bit overboard when it comes to predicting rising interest rates, but what he is suggesting is that the Bank of Canada needs to increase interest rates sooner, but do it more slowly rather than waiting for inflation to rear its ugly head and then doing it all at once. But whether you're on the side of thinking that they should do it sooner and raise rates slowly, or do it later and raise it all at once, that doesn't change the fact that the primary reason he's advising this is because he believes that the rate sensitivity for any sort of rate increases is 30 to 40% higher than it was in previous years. So let's talk about that. What does that mean? Well, there's always these people that go back and quote the 1980s like the 1980s were anything like what the 2020s were. And really that just comes down to generational data and generational experience. And quite frankly, where we're at now in a super low interest rate environment is nothing. I don't know. It's just not like the 1980s when they were in a high interest rate environment and also had high inflation, because the frameworks and everything that the Bank of Canada, the central banks, used to determine inflation and determine interest rates were completely different back then, let alone it's a completely different circumstance today. But the point I'm trying to make here, and what's important to understand, is that back in the 1980s, changes in interest rates had very little sensitivity. So in other words, you had to make big changes in order to get small results. And what Tal's saying here, and I agree with him 100%, because the data supports this from Japan in the 1990s, 1920s to 1950s in the US. And what the data supports is that when interest rates get really low, changes to interest rates have higher sensitivity and therefore have broader impacts on the economy. And in this article, Benjamin Tal is talking about a 1% increase in interest rates could be, in theory, devastating to the economy. So what does that mean? Well, what it means is that if interest rates are increased even 1%, well, it means that people are going to struggle making their mortgage payments. Now, keep in mind, obviously, that people have been qualifying at what's called the stress test rate, which, by the way, for those who believe that price to income ratios matter, which I don't really, but those who believe that the price to income ratios of houses to income actually matter, the stress test actually qualifies people at a 4 to 5 times ratio, which is generally what's accepted as the ratio that provides for a stable housing economy. So obviously we're at 8 to 9 times that price to income ratio when it comes to actual housing prices right now. But what people have been qualifying at is actually at 4 to 5. Now, when you look at the fact that an increase to interest rates could have a devastating effect on the housing market and on the economy, what that means is that the Bank of Canada is probably going to have a really hard time increasing interest rates any more than about 1% in the next 5 years, because that change in interest rates would have a devastating effect on people's ability to purchase houses or people's ability to maintain those houses. And the big thing there is that if they aren't able to maintain their debt and foreclosures end up happening and you end up in a scenario where the housing market tanks as a result, well, now you've got to go back to lower interest rates and basically rebuild the economy. So they're likely not going there. And by the way, if you're one of the people that is hoping for high inflation and you are hoping for high interest rates, you are betting against the housing market. And if you're betting against the housing market, you're betting for an economic crash. And that more than likely means that it's not going to be easier for you to afford a home. What it more than likely means is that you're probably going to get swept up in the exact same economic issues that everyone else is. And things like having an income and having a stable job and all of those things are going to be a lot harder to come by. So while you're betting against the housing market and wishing and hoping and praying against the housing market, you're also betting and hoping and wishing and praying against Canadians. So you have to be very, very careful about that process and that line of thinking. And the other thing you need to consider is that if you're sitting here waiting for interest rates to go up and the housing market to crash because all of a sudden housing prices are more expensive than they ever were and they aren't as affordable, well, the affordability numbers actually haven't changed since pre-pandemic. Now you're probably sitting there going, well, hold on, Nolan, what the heck are you talking about? Of course the affordability numbers have changed. Housing prices have gone through the roof. Well, the housing prices have gone through the roof, but the affordability is still very similar to what it was. And let me show you what I mean by that. Okay, so first and foremost, let's just assume that everybody is out there buying $850,000 to $900,000 homes. The difference between an $800,000 home and a $950,000 home from a down payment perspective is $15,000, which isn't that much when we're talking about homes that take at least $200,000 in household income a year to buy and ultimately have basically $800,000 to $900,000 price points. Now, here's where it gets interesting, because when you look at where interest rates were a year and a half ago, they were around 3%. And if you were to buy an $800,000 house about a year and a half ago at 3%, the total amount over 25 years that you're going to pay for that house is about $1.131 million. And that includes all the interest and the actual amount of principal that you would pay down. Now, if you look at it, what's happening today, now we have interest rates of 1.45%. And, according to TAL, a very highly unlikelihood that interest rates are going much higher than 2.45% in the next 4 to 5 years. Well, you look at 1.45% versus 2.95%, and that same payment, that same $3,777 payment right there, that payment affords you now a $950,000 mortgage. And the interesting thing is that the total amount you would pay, the amount you pay for the property and interest, ends up being $1,133,000. So there's a $1,260 difference in the lifetime cost of this property. So 25 years, there's about $1,200 difference. So here's the thing. While people think that the housing prices and the affordability have gone down significantly, the actual cost to carry have stayed almost identical when you look at the increase in prices versus the decrease in interest rates. And what that means is that if there's a big increase in interest rates, that is going to be an effective increase in housing prices. But right now, with the decrease in interest rates and the increase in housing prices, we're still paying about the same for a house that we would have paid about a year and a half ago. The difference is we're just paying a higher nominal value for it, which is the price tag, if we completely ignore the interest rates. So here's the thing. If you are thinking that houses are going to become more affordable because the prices are going to crash, the reality of it is this: yes, it looks like we're going to get a little bit of relief from skyrocketing prices. There's probably going to be a little bit of a correction, but my guess is it would be highly unlikely that we see a correction of more than 5 to 10%, probably closer to 5%. So houses are probably not going to get significantly cheaper. And if they do, it's because interest rates have gone up. And if interest rates have gone up, well, guess what? You're paying pretty much over 25 years the same price for that house anyways. Now, I get, yes, that there's a lot of things that can happen. Yes, if you bought a house 5 years ago and you've been able to refinance into a lower rate now, you are far better off than somebody who's buying right now. I totally get it. But what I'm trying to say is this, is houses are probably not going to be more affordable from a dollar perspective when you look at the total price of the house for a very, very long time. And the thing that's going to happen for that to happen is you're probably going to have to see things like wage increases across the board, higher inflation, yes, probably slightly higher interest rates, but you're going to have to see a complete rebalance in the economy. And that is something that's going to take 5 to 10 to 15 years before we start feeling like, hey, $1 million house, forget that. That's nothing. That's like, a $300,000 house in the early 2000s. That's easy to deal with, or in the 1990s, that's easy to deal with. But it's going to take 10 to 15 years before we start looking at $1 million price points and go, hey, that was fairly cheap back then compared to where prices are now. So if you're expecting that houses are going to be more affordable in the next little while, yes, there's more supply coming online. Yes, there is lower building costs that are lower than what they've been for the last 5 to 6 months. But at the end of the day, most of that isn't going to get passed along to the consumer. Most of that is going to end up in the pockets of the builders and the developers and all of those people. And you're probably going to end up paying pretty similar for the next 4 to 5 years to what you're paying now for a house. So when are houses in Canada going to become more affordable? Well, when you start making a higher income, when you have a bigger down payment, but don't bank on the fundamentals changing, because what's happened pre-pandemic to now, the total cost of houses, the fundamentals haven't really changed. It's just the ball got moved from prices to interest rate and so on and so forth. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Don't forget about our courses that we have, Secrets to Getting the Lowest Interest Rate, as well as our First Time Homebuyer Guide, where we teach you how to navigate all kinds of issues like this. And don't forget about our race to 25,000 subscribers. I sincerely hope that you, yes you, end up being the winner. We'll see you on the next video. Cheers.